on the screen, but we also have to welcome in our next guest on the show. Jayakumar, Group CEO and Managing Director at Prime Securities, is with us. Jay, it's always a pleasure to have you on the show. I remember our last conversation where I think it was just after the Infi debacle, Q4 debacle, and I remember you saying that expect some of this money to start moving out of IT and rotating into pharma. What's your view? What makes you bullish on the space? Are you holding that call? And what kind of companies? I mean, there's a Mankind, for instance, in this last couple of weeks, we've seen a new listing, and that's an entirely India pharma story. Then there are the US companies. Gland, a name like Gland is suffering big time. Divi's has had a good run. It's a very diverse sector. So therefore, I want to ask you, drill down a little deeper and ask you, what in pharma should one consider?
Well, there are two. For starters, thank you for having me on the show. The important thing on, when we last looked at this was we saw the trends in technology and took a call that people will downgrade their holdings in the technology space and move to possibly another export-oriented theme, which is, in this case, pharma. 4 or 5 things have happened. One is that a number of smaller companies in the US have actually fallen by the wayside. And it's also happened in terms of event risk being higher for smaller companies, even in the Indian context. And if you've noticed, the markets have been positioned quite negatively on pharma till recently, which is why if you see, for instance, just to give you a comparison, like banking, people have been positioned long. Results have been, in many cases, better than expectation, but prices have come off subsequently. In pharma, for instance, many of the results have been disappointing. And people have actually, if you see the research reports, people are justifying 25 to 27 EV/EBITDA multiples, 30 times PE multiples, 30 and north of 30. So in that context, markets, despite seeing not great results in the pharma space, have actually started moving up. So A, the positioning of the market is in favor of pharma stocks. That's number one. Number two, the general commentary, if you can go through the analyst and the conference calls of managements, indicate a declining pricing pressure, especially in the US, which means that the US, which is the world's biggest market for pharma, is seeing a dramatic, I would say dramatic, maybe an exaggeration, but a strong decline in pricing pressure over the last few quarters, especially on the generic space. So generics in the US, good market to good sub-segment to track, where the pricing pressures have come down, logistics costs have come down, input prices have come down, and consolidation in the industry is taking place with a lot of smaller companies having fallen by the wayside. A few, in fact, have gone into bankruptcy as well. That's one particular takeaway. The second is, I would say that the domestic stories and the manufacturing part of it is buttressed by a big call on PLI. There are 1 or 2 companies that have got large PLI approvals. And the largest in this has been a 2,400 crore PLI approved for one single company. Now, the advantage of a PLI investment is many of the pharma companies, including this one that's got the PLI approval, are cash rich and very, very low on leverage, if that. Most of them are net cash positive. The PLI has meant that for a 2,500 crore investment, you probably get operating incomes of operating margins of close to 30 to 40% because you're actually shifting out from places like China in terms of sourcing either the intermediate or the starting pharmaceutical ingredient. So from that point of view, you're talking about almost 700-800 crores of operating EBITDA, plus 1/5 of the PLI comes back to you in terms of government payments back to you. So many of these companies in this space, especially the larger ones, could get up to 800 to 1,000 crores of additional EBITDA purely because they've moved into a PLI here. And I think just like the PLI has benefited so many other sectors, pharma could be seen to be that sector here. The third thing is that some of these companies have actually gone through with their Capex related plans and will end up becoming seriously cash flow positive and more importantly, free cash positive. And that actually could be a big plus again for the years to come. And apart from all this, logistics input prices have come down. So margins actually are on the mend. So given all this, I think pharma is a good space to be in. Add to this the fact that the dollar index actually held out at 100.5, did not break down, and on the way up is actually now close to 103 and a little beyond that. Were the dollar, which had been shorted into through these crises of the banking system, etc., in the US, were that to actually the dollar not to decline, it's possible that the Indian rupee may go past 83 and head towards 85, 86 over the next 6-9 months, is the house view that we have, which essentially means that that's one more tailwind for the pharma space. So this is a kind of a deep dive into why we like pharma. And most importantly, as I said, the markets, the funds, both overseas, FPI and local, are actually under position. And most of big pharma companies are high on promoter holding, very low on any pledge, low on institutional holding, and even lower in this context as of today.
All right. Hi, Jakes. Good afternoon. Always good hearing your thoughts, Jakes. I want to ask you about the cement themes. That's one of the plays you have, right? Getting into an election year. But could you tell us how do you play this theme? Would you look at the big boys? Would you look at the smaller names? And if any view on ACC and Ambuja, because they have been the big movers in the last few days.
So most of these companies, again, in this space are not that heavily leveraged. Consolidation is happening all the time. And I think the bigger theme is not so much cement. I think it's cement and steel in the context of an election year. So you would probably have multiple companies that will be beneficiaries of this theme. I believe the Capex, just look around and see what's happening in just Bombay alone and what plans, the state talks about how they're going to reform and change radically everything that is there in the Bombay skylines. And it's happening as we speak. So whether it's cement and steel from a national perspective, or more importantly, Capex related in an election year and 2 years beyond. So this is a more general call on that. Again, I feel while cement is well owned by a lot of funds, steel, for instance, isn't. And one of the tailwinds or should I say triggers for this could be something that's happening on the geopolitical front where every pronouncement of an international leader seems to have India as his or her friend in a geopolitical sense. I think this is not falling on deaf ears. China is keen to get back what it's seeing as if not an exodus, but people tactically moving manufacturing out of China into other parts of the world, notably India. So whether it's actual physical movement of money, which is the China-India play, and there's more money coming to India now moving out of China, after the last tactical play into China did not work out. Number one. Number two, FDI flowing into India, where people are setting up manufacturing bases here. And number three, from a geopolitical front, the fact that India is mentioned in the same breath as the best friend of the most favored nation kind of thing in most countries is not falling on deaf ears. And I do believe that China will need to do something which it hasn't been able to do. Demographics aren't helping them. My assessment is that they may brute force this with a stimulus that could be pretty dramatic. And if that were to happen, a sector like steel or some of the commodities could actually see activity where in any case, after high interest rates in most, if you see the last 150 years of high interest rates, every government that has sought to pay down its debt on the back of high interest rates, higher principal and interest repayments, has sought to do that through Capex, has sought to do that through construction and reconstruction of real activities and real assets in the economy. So from that point of view, there's a developing Capex theme which I suspect will happen. And more specifically, China with its stimulus could be the joker in the pack. And this could happen pretty soon because the developments, as I said, on the geopolitical front and on the FDI front, as an outsourcing front, manufacturing, exports, etc., India features everywhere. So from a market standpoint, I think every dip will be bought into, as we are seeing. Markets could make new highs. And specifically, some of the themes that I talked about are what we are backing.
Jake, so if one needs to make space to own pharmaceutical names, what are the sectoral holdings that you would recommend paring down in your portfolio? If you don't have incremental cash to put to work, say in sectors like pharma, you need to pull out, sell down some of your other holdings. Which ones would you recommend?
Pharma, I would say that movement to pharma can happen through multiple, but principally the overall space. So what I would consider in that would be maybe even at some level, well, banking still as a way to run, but tactically you could look at paring down banking. That's one. But I think the bigger theme for a reduction would be FMCG and consumer. I think that's very richly valued. It's on the strength of low single-digit growth. These multiples, like the case of Asian Paints underperforming and so many others underperforming the last couple of years, clearly indicates that money is and has been moving out of those spaces. So there are spaces that we can pull out, and I think these would be principally there.
Jakes, this has been a rich conversation. Thank you very much for joining in. Look forward to another chat. For now, we need to slip into a very short break. On the other side, we'll get some BTST calls from our technical experts.